Hi everyone, I'm excited to bring you the next installment in my Q&A with Wall Street series. In this episode, I'm going to do FedEx stock and its most recent quarterly conference call with analysts on December 20th. So let's get right into the Q&A session. The first question comes from Thomas Wadowitz asking about what's driving the additional $1 billion in cost reduction. And if you're new to FedEx stock, which I don't think you are, otherwise you wouldn't have clicked on this video. But if you're new to FedEx stock, I'll remind you that they've implemented a massive cost cutting plan where they expect to achieve over $4 billion in savings, and they implemented an extra $1 billion in savings in the most recent quarter. So that's what this analyst is asking about. And here is the CFO jumping in to answer, saying it's a combination of further flight reductions. So they're reducing the number of planes they have in the skies, the number of planes that they're using for shipments, both internationally and domestically within states. Their incremental sortation center cancels, and this is particularly going to increase after the holidays, right after the peak season, and adjustments to their ground operations, primarily in the pickup and delivery space. So that's how they're going to drive that incremental $1 billion in cost reduction. The next question comes from Helena Becker asking about the reduction in capital expenditure. So the CFO again jumping in to say they've certainly deferred a number of facility projects and initiatives, so fewer warehouses, fewer facilities. And then another piece of it is a change in our aircraft payment schedule as well. So we've pushed that out further, but the number of deliveries remained unchanged, just the timing in that sense. So instead of accepting more planes or payments this year, they've just kind of pushed it out in this fiscal year. Sorry, they've pushed it out to lower the capital expenditure this year, which makes sense since volumes are declining this year. And then a follow up question with respect to salaries, wages, and benefits. I sort of thought that there was some decline there that looked kind of okay. Can you explain that? And the CFO again saying that we will see that mitigating in terms of year over year increase in wage rates relative to what we were seeing earlier in the year. So that's really good news for investors and overall, just from if you're, obviously if you're investing in FedEx stock, you've probably invested in a group of other stocks. This is good news for all stocks that wage rates are beginning to come down, because that's the stickiest part of inflation that the Federal Reserve has indicated is going to be the hardest to bring down. Inflation is plaguing businesses of all sorts and sizes around the world, and the Federal Reserve is raising interest rates to bring down inflation. And it's a good sign that we're seeing some moderation in wage rates already. So maybe the Federal Reserve won't have to increase interest rates so much. And then we have Jordan Alleger from Goldman Sachs asking about the $13 to $14 range. And this is referring to FedEx's earnings per share outlook of $13 to $14. And Jordan wants to know a little bit more about that. And so the CFO again jumping in to say, while it's true that volumes are declining, right? Their package volumes have been declining. We expect those to moderate as we move through the rest of the year, particularly in the fiscal Q4. We're going to have more yield pressure relative to the increases we saw in the first half of the year. So in the first half of the year, they've been able to raise prices that they charge their customers, and so that's been driving earnings per share higher. Even as the number of units that they're shipping is dropping, they're able to earn more per shipment, and that's why their earnings per share is staying at the level it's staying at and not declining, is because they've been able to increase the price per package. And I will end with this question from Ken Hoexter from BofA Securities. So just to clarify, does that mean that these are just a reaction to slowing revenues and so cyclical? What this analyst is referring to is the billions of dollars in cost cuts that we talked about earlier, asking about if that's just a reaction to the declines in volumes that FedEx is experiencing, meaning that when volumes increase, are you guys going to increase these expenses again to match up with the increase in volume? So is it cyclical or are these reductions permanent? And so the CFO jumping in and saying, well, Ken, we talked about a permanent reduction of 1 billion from the fiscal year 2023, and that recognizes that we're in a unique circumstances over the last year and a half and 2 years, and those reductions would not return under any range of normalized demand scenarios. So even if the demand recovers, this $1 billion that they saved on expenses is not going to come back. Okay, so these are permanent. And then mentioning that we parked 5 additional aircraft during the second quarter. By the end of the fiscal year, we're projecting to park 11 more aircraft. So they've already parked and put out of service some of these aircraft, and there's going to be 11 more that's going to be put out of service after this peak holiday season. After they get through that peak holiday season, that's going to drive a lot of cost discipline, cost reductions. All right, so that's all I've got for this episode in my series of Q&A with Wall Street. I hope you enjoyed that, and I hope you come back for my next episode. Until then, thank you for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.